Hello, everyone. Today on the final bar, my guest is Gary Dean from sentimenttiming.com. We're going to talk about some of the sentiment reads in the market right now. We continue to have this juxtaposition of an uptrend that continues pounding higher and higher with S&P 3400 not too far away, looking down the road. But at what expense, right? Looking at the different patterns, we're going to dig into the financial sector a little bit, some stocks that feel a little left behind in the current uptrend. Ladies and gentlemen, this is the final bar. Hello, everyone. Good afternoon. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close for our show, trying to make sense of these markets from a technical perspective, measuring this unrelenting uptrend that continues unabated, it feels like, with more and more stocks like Disney blowing out to the upside, continuing to push the major averages higher. But it is not a complete picture. The goal here is to connect the short-term movements, what we're seeing today, those upswings, but connect it to the long-term trends. We're going to focus on somehow how those trends have evolved from a sentiment perspective, and think about what they mean. Particularly, we're going to dig a little bit into the financial sector. You're looking at a chart of Goldman Sachs, for example. It's really range bound. So as much as the market has felt like long and strong up and to the right, S&P 3400 plus, there are plenty of stocks that don't look like that. And so what we're going to do is dig into some of the different themes that we can look into. As a stock picker, I think you're hopefully well equipped to diversify it across a lot of different potential patterns, potential themes. We've got a lot of guests to help us along the way. Gary Dean joining us a little bit later on this show. Tomorrow we have Julius DeKempener, founder of RRG Research and fellow StockCharts TV host. Next week we'll have Larry Tantarelli on August 11th on Tuesday, and then on Wednesday Jane Galena from cjanetrade.com. On Monday, August 10th, our next episode of Behind the Charts features a conversation with Josh Bellinger. I had so much fun talking with Josh about getting started as a runner on the floor of the exchanges in Chicago. A lot of great discussions about the feel of the supply and demand, the fear and greed, the raw emotion, but the discipline and the emotionless transactions that happen in the dynamic nature of the pit. So a really cool conversation with him. Let's get to our market recap. So as I mentioned, this uptrend continues. I feel like there have been plenty of opportunities for the market to pull back. As I've highlighted recently, just looking at the charts, it feels so reasonable that we should have a 5 to 10% correction. If you ask anyone who has been investing for a longer period of time, they will tell you that a longer term uptrend needs to have those pullbacks, because those are those digestion periods. Those are the times when you have a big run, and then you have time to sort of lick your wounds, digest, regroup, and that sort of builds momentum for the next leg higher. And as much as we've had a couple pullbacks in the last couple months, we continue to blow out to the upside. And again, you'd feel like a more extended, more reasonable pullback to digest the previous gains and give everyone else a chance to reset would be good. And arguably, if you are bullish, that might be the thing you want the most, is some sort of pullback to bring more buyers in, because anyone that's missed out on what we've seen so far, if they're not in there yet, a pullback is when they would most likely jump in. And this is the feedback loop that tends to propel these bull markets much, much further than you might expect. Today, we saw the S&P up 0.6%, above almost to 3330. It touched there, in the morning session, but around 3328 to close. Mid caps and small caps up even more, with small caps leading the way higher, up 2.2%, and really just a consistent uptrend there. So certainly felt more like a risk-on, leading higher type of market. We've talked about leadership, though, and my guest yesterday, Andrew Thrasher, had some great charts about technology, and I totally hear what he's saying, and in generally agree with him about tech as a safe haven, but as offense as well. But boy, the last couple of days, last week or so, you've seen plenty of opportunities where the market's gone higher without technology being the big driver there. In this case, tech sort of middle of the road, and communication services, which is Disney's sector, actually down today. So an interesting rotation of sorts, with Financials, a group we're going to talk about a little later in the top three for the day. Just touching on some of the other asset classes, we've talked about this unsustainability of stocks, bonds, and gold all going up. In terms of today, bonds certainly weakened with 10-year yields going back up. Bond prices in the form of the TLT going down 0.85%. On the commodity side, gold, silver continuing to rally pretty significantly. The SLV just in this incredibly consistent uptrend, driving to higher highs and higher lows. There's a chart of the SLV. It's essentially gone vertical, gone parabolic in the last couple of weeks, and gold not far behind there. So the precious metals certainly have gotten a bid pushing that higher, and that's a theme we've been talking about for a while, but now it's really sort of accelerating to the upside. Let's look at a chart of the S&P, and again, if you, I don't know how you wouldn't recognize the uptrend by now. I mean, somewhere along the way, I was talking with a friend of mine yesterday. We were talking about analysis, and at what point did you see enough evidence to confirm that the market was going to go higher, confirm a bullish thesis. And I would say, I told him kicking and screaming, I decided that the trend was not down anymore because I was just so mentally prepared for much deeper lows. And every time the market pulled back, it ended up being a higher low for the most part, and all signals continued to point higher. What's interesting though, there's this behavioral bias called hindsight bias, which basically means the further we get from February to March, the more optimal your own trading experience will feel in your own memory. And what I mean is, you will convince yourself the further that gets away in the rearview mirror that you pretty much, like a genius, called the bottom on March 23rd, and you pretty much identified the top right in the third week in February, even if reality was not quite as pristine, and that happens as investors, again, called hindsight bias, where we sort of improve our own trading performance in our own mind, and it speaks to the importance of keeping a good record of what you're thinking and when, and your charts are a really good place to put comments like that. We've seen signs along the way. The bull flag pattern we saw here in May, a bull pennant pattern here in June. All of these measure to much further highs, just this continued pattern of higher highs and higher lows. Breakouts continue to be confirmed. I think at this point, fairly reasonable. We hit S&P 3400, as I've talked about, a break above 3200 with confirmation, which we've now gotten. Tells me we go to new all-time highs. And again, I will be the first to tell you that has not happened. If we get a lower high and a lower low, and at this point on any pullback, 3200 certainly feels like a very reasonable point to expect support. It's interesting to see we're right at that point where a bearish divergence no longer looks like a divergence, and that's if we break above this peak on the RSI, because all of a sudden we're no longer making lower highs on the momentum indicator. So bearish divergence is higher highs in price, lower peaks in RSI. I think we're right at that point where we also all of a sudden have to call this a failed divergence and a continued uptrend. Let's look at some other charts, just themes that we saw today. As I mentioned, leadership is kind of interesting. Materials, one of the top sectors, and the XLB is in this case driven by a lot of different pieces. Gold stocks are one of the places we've looked a number of times recently. Let's look at what actually drove it, though. It was aluminum stocks, number one, non-ferrous metals, so in that a similar space in the top two. But you also notice a number of consumer discretionary, like footwear. This is like Nike, clothing and accessories. Industrial is the number one sector. You see aerospace, airlines, and marine transportation. So something like airlines, I mean, to be honest with you, it's with a great amount of skepticism that I talk about airlines being in the top 10. Again, it's so tempting to look for beaten down spaces. And if you're more value oriented, you like buying weakness, I get the argument for buying something when it's at support around, these 120 to 125 range. When the RSI is hitting 40, that's about normal in a bullish trend. The relative strength is still relatively muted because it's so beaten down from the beginning of the year. So I get the idea of it. It's so not how I like to look at things. I would much rather buy things that have established an uptrend, that have shown that buyers are sustainable and buying pressure is sustainable. And we've not really seen that yet. So something like airlines being up a lot today, that's great. Like to see it. But again, for me, thinking longer term, I'd be much more interested in seeing the ability of the stock to break above swing highs than to rally quickly off of previous lows. In terms of groups driving things down, biotech again in the bottom 10. This is something that's been emerging. You think about healthcare. A chart of Merck comes to mind as something that Let's bring that up real quick, actually. Something like Merck, which has been testing its 200-day moving average within, and I'm thinking of healthcare more broadly here. Stocks within healthcare, part of me feels like, boy, this is a nice break above the 200-day moving average. The concern is it's tried that a number of times over the last 6 months, and pretty much every time that's been repelled and we've pulled back. And so the relative strength is really pretty poor because most stocks are, breaking to new swing highs at least, and approaching previous highs from the beginning of the year. Healthcare as a group has sort of been left behind, especially big names like Merck. So they're interesting charts to watch, because the question is it able to hold the 200-day? Is it able to continue this move higher? And if so, then you can get the sense that healthcare as a play overall would be doing pretty well. When you think about biotechs in particular, the IBB is one place to look. A chart of Amgen comes to mind, and it's, as we've talked about, it's sort of at that decision point. This is either a very buyable, very reasonable pullback in an uptrend, higher highs, higher lows, pulling back to the 50-day moving average, pulling back to the swing low from early July, RSI pulling down to 40, which is about what it did back here in June. And is this a similar setup before the next leg high as biotech leads the push further to the upside? So, it's an interesting, the group has come off and it's pulled back to support a lot of names like Amgen, pulling back to an ascending 50-day moving average. This is sort of that decision point. Either this is the buyable low, which I think it's a reasonable bet to want to take. Or if we start breaking down through swing lows, breaking down through the 50-day, breaking down through the 200-day, then you have to start thinking about other places to go outside of things like the IBB. That's our market recap for today, trying to touch on some of the technical themes that I was picking out. We'll take a quick commercial break. We'll be back with Gary Dean. See you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We love hearing from you. Feedback on the show, especially questions about what you're running into as you try to navigate these markets through the lens of technical analysis, through the lens of charts. Get a hold of us two ways. One is via email, thefinalbar@StockCharts.com. Second way is on Twitter. Just tag us in a comment at FinalBarSCTV. We'll do another mailbag segment at the end of the week. We'd love to answer your question on the air. I want to welcome on my guest, Gary Dean. Gary's at sentimenttiming.com. We were just talking before the show, Gary, about the weather that you're facing in the Northeast. So thanks so much for coming on. Glad you're making it through relatively unscathed, but I know it's been a tough stretch among tough stretches here.
Yeah, thanks for having me on. Yeah, thanks for having me on, David. Like you said, I escaped with limited damage. Nothing major here, but town next to me got hit.
It's good to have you on. You and I actually spoke on a panel together not too long ago, and it's been a pleasure to get to know you and your work a little bit more. And I know one of your partner, Woody Dorsey, has done some fantastic work for a lot of institutions focusing on sentiment. So I'm really interested to see your first chart relating sentiment to tell us.
So what we're looking at, I think the big the 0% is that everybody's bearish on this market, and at the 90, the highest it goes to see those too much when you want to pay attention. Very tops in the market in the past, but what happens, David, is that we're very in the past we typically get V off of that. When you get 0% from there, we go straight up, and the the 95%, those are rounded. So you'll start to see that if you go over a little bit more to the right towards like July, where the cluster of 90, 95, the tops are made a lot different than the lows, where you'll see a series of bullish sentiment readings on it. And what I like to follow this, and I've had a lot of discussions with Woody Dorsey on this, but if you notice the moving average, the 6-day moving average, that's the blue line, that's on the chart there. So this right here, you can see that there's a divergence going on with sentiment, where the short-term sentiment is popping up. We had a 95 and a 90%, but you can notice that the 6-day sentiment reading is a 6-day moving average is actually diverging. So it's telling us that even we're getting these spikes in the sentiment, the overall day-to-day readings aren't as they're not following through on the upside. So it's a warning sign. It's not a sell signal. What we try to do is mark it up with certain turn dates. So we have August 12th is a date that we're looking at, and Woody actually has it as a low. So if that is going to play out, then we would see some weakness. I know I heard you talking before about a 5 or 10% pullback, and what in this market, what everybody should be noticing is it's an all-in, all-out environment, meaning that if we get a 10% correction, it could be something that happens in 4 or 5 days. It just everybody's in or out, and because that's one of the things that we get at, like, how can you think we'll go down that low? And I'm like, did you see the S&P 500 drop 180 points in one day? So it's one of those crazy things. But sentiment is definitely we're seeing more and more people just really looking up on it. So it has me a little bit cautious on this market right now. And the chart that's to the right of it, that's just your S&P 500, and this is a fractal pattern. I'm a big bully. I love following them, and if you notice where you have the wave structure to the left of it, and that was in the going into the 2020 time period, that's just a wave structure on it there. So you have your 1, 2, 3, 4, 5. You can see the divergence that was taking place, and we actually have a very similar type pattern that's in play right now. Now, the fractal patterns, they're never going to follow them identically. They're going to mimic, but it has the sentiment readings that we're seeing right now, along with the wave structure and the divergences, again, has me, one of my targets that I've had really since March was this the 33,330, because that was the open gap in the S&P. And I really did not I didn't believe that we were going to get there in this type of fashion. I did. So as much as I had that as a target back in March, I no way was I expecting it to get to here, like in this, just a V shaped like this. I thought it was going to be very choppy, and I still am leaving the door open for this market to be choppy. But as far as getting to this level this fast, no, that one took me by surprise. There's no doubt about that.
No, we only have about 30 seconds left.
Okay,
but
no
I do want to
problems.
get to your second chart very quickly.
Yep. So this is just
sentiment,
Yep. So this is just the stocks above the 50-day moving average. That's the first chart. You can see that as the S&P is heading up, that's actually heading down, telling us that less and less stocks are participating in getting the S&P up there. And really the other one underneath that is just your put call ratio. And it's another fractal pattern that we saw going into the February top on that part. So that's really, those are the things that I'm watching right now. And they're fractal patterns until they're not. So it's not something that you make massive trades off of. You follow when the turn dates are and sentiment and everything on that end.
Perfect. So a number of headwinds, it looks like, just thinking about some of these divergences, and not just on one, it's a number of these different indicators sort of lining up there. Gary Dean, this is such a pleasure to have you on. Thanks so much. And again, stay safe. Hope you and your family do well, and look forward to talking to you again soon. All right.
Thank you, David. Have a good.
That was Gary Dean from sentimenttiming.com. And again, it's interesting. It echoes a lot of what we talked about with Andrew Thrasher yesterday, particularly looking at the percent of stocks above their 50-day. And they both picked up on that lack of participation, or less and less participation on each upswing. Something to certainly pay attention to, and definitely on my radar. Let's get to our next segment, deep dive. And what we do on a sector deep dive is pick one sector and dig a little deeper, trying to focus on some of the key themes. And today we're going to dig into the financial sector. We love to do this occasionally. And again, we talk about sectors every Monday, a little bit on Fridays as well, but usually on Mondays as part of our three-pronged approach to market analysis. We do a little work of sectors, thinking about the RRG charts, the sector individual charts, and then digging into individual stocks. Here we want to dig a little deeper on some of the groups that comprise those sectors and what charts you may want to be familiar with. So let's start with the chart of the XLF. And financials up pretty good today, outperforming, which is good to see. I think it's worth noting the challenge I have with financials as an overall theme is that it's been underperforming for a while. And this is not just a new thing. It certainly has been underperforming going into the February market peak, underperforming essentially through much of the recovery period. There was this period right about here, mid-May to early June. This is leading into the June market high, when it felt like financials were going to be the next leadership. And I remember thinking, wow, regional banks looking good. The average financial stock looking pretty decent. It's actually setting up well with a lot of upside. And it wasn't just that, it was, other things like, market access and those specialty finance and financial administration names. But it wasn't to be, right? Since the June peak, things sort of right-sized a little bit. And some of those groups that had been leading, this is when airlines are ripping, all these things, breaking out to the upside. This is the end of the FANG trade. And that was obviously a little premature because once again, those mega cap tech consumer names leading further, and financials pull back pretty well. From an absolute basis, just looking at the price chart, ignoring the underperformance, which we've mentioned, I think it's interesting to note that from the February to March sell-off, you rallied pretty much right to the 38.2% level. Every time it traded above it, we pulled back. So that was like the first leg higher. We then moved up to just above the 61.8% level. This lined up with the 200-day moving average, which is pretty much the peak for financials since then. Came back and now tested support at the 38.2% level, which is also the upper end of this gap here from late May. Overall lining up pretty well around 2250 for support. Look at where it is now, which is essentially dead even, right? So while other things have, are sort of testing the 200-day like Merck, other things are breaking and testing all-time highs like Apple. Stocks like the XLF are sort of in no man's land, sort of in this range between the 200-day and the upper Fibonacci resistance and the support level around 2250 on the XLF. Right now, it is at the 50% line. It's also testing the 50-day moving average from above, which overall is pretty good. What you'd like to see, obviously, from the XLF is to go back to resistance, which is basically a confluence zone now around 61.8%. Also, the 200-day moving average right around 2570 or so. You'd want to see that, in my opinion, break out, which hopefully would see an increase in relative performance as well. On any pullback on the XLF, you've got clear support around 2250. I think that's a real significant level, and if that's unable to hold, I would be avoiding this very, very quickly. But let's look a little deeper. When you think about the chart of the XLF, an example stock, I think, that tells a story. Goldman Sachs may be as good as any. Looks very, very similar, right? You have the peak here in January, the sell-off in March. You rallied back, and now again, we have clear resistance around 225, 220, 225. That's the resistance from early June. We've now retested that in July. We now have a pretty good support level as well, right? Which is around 190, 195. That's from a number of lows, and the key low here, I think, is that swing low from June. So now you have this range around 225 to 190, and we're in the sideways zone. And what's also interesting, if you look at the RSI here, this is what a sideways trend looks like. It's what a consolidation pattern looks like. We're rarely getting above 60. We're rarely getting above 40. We actually haven't done it in quite a while. It's just literally just toying, just revolving around that 50 level on the RSI. That is the definition of a neutral rating or a sideways trended consolidation pattern. One of two things happens at some point. It can continue to go sideways for a very long time, don't get me wrong, but at some point we break above 225, we break below 190. And I would argue whichever way that breaks, that's the trend I would be most likely to assume to continue. That's the momentum that you would want to follow, because what this tells you is that buyers and sellers are pretty much in agreement as to how much this stock is worth. When it breaks above resistance or below support, that tells you that one side has taken control. We have recalibrated, we have redefined what the valuation should be, and the market has decided it's no longer meant to be in this range. Until then, you're sort of treating the upper end as resistance and the lower end as support. So let's dig a little deeper in here. If you go to the sector summary page, and the way you get to there is click on charts and tools, you'll find a listing for sector summary. It's a great way to look at a particular sector and see how it lines up. If we go back to the main sector summary, which is here, you'll see how financials relate to all the other sectors. So the number one sector sorted by Scooter rankings is technology in the top decile of ETFs. That makes sense. Followed by consumer discretionary, followed by communication services. These are the Fan Mag, whatever we're calling them, basket of stocks, are essentially in those sectors. On the bottom, you have energy at the lowest, and then financials not far behind them in the almost the lowest decile. If you click on the financial sector, again, we'll get the groups that comprise the financial sector. We're going to sort that by their Scooter ranking. So essentially in order of technical attractiveness, and you can see financial administration, number one. You can see at the bottom, in a full line insurance. The challenge for financials, if you think about where a lot of the big market cap is, it's places like banks. Now, this actually has all the regional banks as well, but it's also a lot of the larger banks like Citigroup and others that you're probably familiar with. That group as a whole has done fairly poorly on a relative basis. Asset managers are kind of in the middle, and there's an interesting mix of stocks in here, to be honest with you. There, some of these, again, that you might be pretty familiar with. Some of these, like CEF, that are essentially a huge play on gold. But you'll see other names in here as well, like BLK, BlackRock. It doesn't look bad. And if you covered up the ticker, if you removed that potential for confirmation bias and endowment bias and all of those biases that happen when you see a ticker and start creating a story in your head, the chart of BLK doesn't look that bad. I mean, it's testing previous highs. It's sort of consolidating. It almost looks like a cup and handle like pattern. This could easily be in tech or communication services for sure. Looks like a lot of the other names, but it's an asset manager with pretty decent market cap. So I'd remind you that, don't think too much about XLF as a basket and think that it is one play. There's a lot of opportunity within there, within specialty finance, within financial administration. There are a lot of different stocks that are represented in each of those sectors. So if you click in, you can dig into them a little further and see some of the charts and how they're represented. Something like MSCI comes to mind. We've talked before about sort of the base case, the broad way that a lot of institutions measure momentum is a strong 1 year and a weak 1 month. And if I'm looking for a chart that tells that in the visual form, MSCI may be one of the better examples of that, with a strong 1 year and decent performance in the last 2 to 3 weeks, pulling back a little bit. So you got the chance to buy a long-term uptrend in a short-term weaker position, sort of like Amgen that we looked at. So, again, with some of these stocks, especially within financial, almost buyable pullbacks within a longer-term uptrend. So don't focus too much on the mega cap banks that you may be familiar with, may be worried about. There's some opportunities a little bit further down the list. Boy, we need to wrap the show. 30 minutes goes by so quickly when I'm enjoying going through charts with you, but we have to wrap. Actually, for the 3 and 3 today, we're looking at 3 different individual stocks, a little different look than we normally get, but thought it was a good time to shake it up. Chart number 1 is Disney. We didn't talk about this, but earnings in the last 24 hours that surprised to the upside in a huge way. Dig into that. Those stories a little deeper. You'll see what Disney was able to do, but certainly, essentially, was able to snatch a profit out of the jaws of a huge loss, and the stock reacted certainly to the upside, up almost 9% today. Traded above 130, settled down above the closing high from June, above the right around the intraday high here. So all of a sudden, this was resolving to the upside, and overall, a chart that looked meager to weak, all of a sudden setting up pretty well. After an earnings release like that, it's all about the follow through. I'd be very interested to see tomorrow what we see from Disney and sort of a follow through to the upside. We talked about Merck earlier, so I don't want to beat this story too much. But again, charts like this at a key decision point, I think, are really important. So either this holds above the 200-day as support, doesn't trade below 81 or so, and continues this next leg higher above the April highs, or this continues to serve resistance as we do another failure at the 200-day, at which point I'd be looking down to the 70s. Third is Nike. In terms of an interesting setup, we've hit resistance around 105, pulled back. Just setting up as a cup and handle pattern. You have to break above 105 to validate that to the upside, but it's certainly on my watch list of potential upside breaks on a stock that I think has been stagnant for just a little bit. Folks, that's our show for today. Thanks so much for joining us every weekday for the Final Bar. Special thanks to Gary Dean from sentimenttiming.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.